People think that crypto, the entire sector, is going to get regulated all at once. That's not going to happen. The most likely scenario, and this is a personal opinion, but one I've been working on in Washington along with others.
Today, we've got a lot to talk about because we got to talk to some industry execs and professionals about what's happening in crypto. These rumors we're hearing about the complete collapse of crypto. Would Bitcoin potentially ever go to zero? And we got to start off by asking Mr. Wonderful, a strategic investor in WonderFi, and Ben, all of us, we got to talk about the collapse of Voyager Digital this morning. Even after FTX's Sam Bankman-Fried came in and bailed them out with an over $450 million loan, they're still filing for bankruptcy. And now individual investors in the platform and retail investors can't get their money out. Folks, Kevin O'Leary, I want to start with you. What's happening here? And then I want to hear from WonderFi and maybe how things are different with you.
You know, this is nothing new in the story of leverage. And so in every cycle, what happens is various actors, companies, take on more and more aggressive positions using leverage to goose returns, which is age-old. It works. It definitely works. Now, what you're going to find in this situation is many crypto operators, particularly lending platforms, have never operated it with such volatility before. So they were in the slow growth from Bitcoin, almost a decade ago, from $800 all the way to $60,000. And all along the way, some of them became really aggressive in using leverage, which is the traditional hedge fund model. Now, what happens, and this happens in equities, it happens in bonds, it happens in real estate, it happens in crypto. Crypto's the Johnny-come-lately new asset class with a whole lot of newbies in it. You're going to see a whole series of these actors get crushed to zero over the next few months. In the contagion of leverage being caught offside with the lack of liquidity. Voyager is not that big a deal. It's kind of irrelevant in terms of, this is a diversified shareholder base. It's not FDIC insured in any way, so it's not putting any stress on the government systems in any way. All the shareholders should consider themselves educated, no different than when you go to Las Vegas, put it all on black, and it's red, you lose. And that's exactly what's happened here. But the great news about this and why this is so good for the market and how this helps the crypto market is it educates the business models that aren't going to work. So it's like taking a big spatula from the sky and scraping all the crap out of the market. And it's going to happen very, very quickly. So anything that was built on a business model that is not going to work or can't sustain volatility is going to be gone, and it's a good thing. It's a wonderful thing. It's going to leave the industry much stronger. Yes, we must mourn the investors that got wiped out to zero, but even they are better off in the sense that they've been educated.
So how do you know what's safe? Kevin O'Leary, what do you look for in a company to know? Because Voyager was a public company. We could look at their statements and their filings from March 31st and we see, well, they had money. And the CEO in interviews told us, hey, we only lend to qualified institutions, or we lend the bulk of our money to large institutions. One of them ended up being Three Arrows Capital, where they lended 33 cents out of every dollar they lent to, who got completely wiped out. So how do we protect ourselves even with public financials?
You own crypto without leverage, and you understand your counterparty risk. Don't worry, by the time all the litigation is over from all these bankruptcies, you'll know everything about everybody. Lawyers are really good at doing that, and there'll be tons of class action, if not just straight on litigation, to go after any assets they can get. And that is sort of, when a fish dies in the ocean, it goes to the bottom, and that protein is reprocessed by slugs. And I'm not saying lawyers are slugs. They have more than single cell proteins, but they know how to get the last drop of any value there, and they're going to get it. It's going to take 5 to 7 years, but all of this is good. So when I hold crypto, and I know it's very volatile, I have zero leverage in any of my positions, because I know tomorrow morning I could wake up down 38% in any token, any coin, any project. And really, that's exactly what's happened. So, but if you put on leverage, you learn the very, very important lesson. You go to zero.
Ben, I want to ask you, how are you different at WonderFi? How are you not lending to hedge funds like Three Arrows Capital? Or if you are, how do you vet them differently? What's different about you? Why are you not going to be a BlockFi or a Voyager?
And this ties back into the question you just asked Kevin, which is how does he decide what's safe to invest in? And one of the things that he has been talking about for many years before he even got involved with crypto was just about compliance and regulation, and obviously coming from the world that he does. And so that is the difference with WonderFi and BitBuy and Coinberry, which are a couple of the brands that we have under the WonderFi banner. All of our platforms are regulated by securities regulators in Canada. And what that means is when we offer products, we have to vet them with the regulators. And so we have to go to the regulators with a plan around how we're going to actually implement something like staking, for example, be able to assess the different risk profiles, have a bunch of processes and backstops in place before we can actually bring that product to market. Now, when you look at a platform, not to single out Voyager, but just as it's in the news, that is something that did have some state licenses in the US, but really didn't have the oversight of a regulator like the SEC or the Ontario Securities Commission in Canada. And so products that they're offering, like that offer yield to customers, and that's what we're seeing implode right now. No regulator had been looking at that or had vetted that to see what types of risks exist for the business and for the customers. And so the regulation piece becomes extremely important. And I think these events with Voyager, with Celsius, and with BlockFi, which are all happening around the same time, this crypto liquidity crisis, that going back to what Kevin said, it's an education for users and for shareholders. It's also part of the growth of the industry. So we will see regulators focus on this particular issue going forward. And we can look back at the evolution of crypto over the last 10 years. There's been significant events like this before. I see this as sort of the second wave of crashes in crypto that lead to specific types of regulation. The first was in 2016, 2017, where you had crypto exchanges that were run by individuals who would basically have control over all customer funds. So this is not even talking about, lending or anything like that. You would deposit funds and then it would, go into the CEO's pocket, basically. And so that led to a bunch of these debacles with Quadriga and other things that led to CCAA and people losing tons of, insolvency and people losing all their funds. And what came out of that was regulators now saying, crypto exchanges that are regulated need to have a third-party custodian that holds customer funds. It can't be in the CEO's pocket. And so that, it's obviously, in hindsight, it makes a ton of sense, but we needed to have that, those incidents happen. And so this is, I think, the second wave of that.
Yeah, that's really interesting because you do get companies that, like Voyager Digital, I'll put it up on a screen here, they have these disclaimers at the bottom that say, hey, they're a FinCEN registered company, they file public disclosures because they're a public company, and so it's certainly challenging at best, and at worst just outright discouraging and confusing for the retail consumer to know, hey, who's regulated the right way? Which license am I looking for? And so I guess the question now is, what's safe in this kind of environment? And I'm going to start, Kevin Leary, I want to hear your take. Are stablecoins safe right now? Or do we need to be worried that if Bitcoin drops to 10K, we're going to see the Gemini token go under because of all this over rehypothecation? Or worse, USDC goes under, and then any company that's offering staking risks some form of stablecoin meltdown. What's your take on that?
Well, let's talk about that specifically, because I think it's a great topic, and for several reasons. Reason number one is people think that crypto, the entire sector, is going to get regulated all at once. That's not going to happen. The most likely scenario, and this is a personal opinion, but one I've been working on in Washington, along with others, is that we would like to get policy on just stablecoins first, because stablecoins represent a very powerful and efficient payment system. And we think we can get bipartisan support between both parties supporting the American dollar as a default currency for a global payment system. It's not going to be the Chinese yuan. It's not going to be the Swiss franc. It's not going to be the euro. It's not going to be the British pound. And the reason it would fall and default to the US dollar would be that that is the currency used to denominate most commodities. And so the challenge you have right now, and why there's so much pressure to solve this, is it's very inefficient to transfer US dollars over to Geneva, then put it into Swiss francs, and then buy Swiss Nestle stock or whatever it is you want to do over there. It's really slow, very inefficient, very costly, not transparent, and not easy to audit. And so all of that problem goes away with a stablecoin.